what's the secret to winning in the stock market? Studies clearly prove it is not market timing. That's a way to get burned. Smart investors know that dividend investing, especially in companies that grow their dividends every year, has one of the best track records in market history. Just ask Warren Buffett. The Black Diamond Dividend strategy through IQ Wealth Management in Scottsdale is the logical and prudent way to invest for strong compounding growth over time with less hassle. If you live in Gilbert and are looking for a more dynamic and prudent approach to investments, learn more about the Black Diamond. Let's listen in on leading financial advisor Steve Jurich of IQ Wealth Management talk about the power of dividends in a recent broadcast of the popular daily radio show Mastering Money on Money Radio. At any point throughout, you can visit our website by clicking the little circle with the eye in the top right corner.
More income, smarter investments. Welcome back to Mastering Money on Money Radio.
Welcome back to Mastering Money on Money Radio, brought to you by IQ Wealth, where financial success is not only possible but highly attainable. I'm Ken Morgan with retirement strategist and best-selling author Steve Jur-itch.
Hey, how you doing, everybody?
It's time now for the IQ Wealth Market Intel segment.
Yes, sir.
Now, the last time on Mastering Money, we began reviewing the stocks that did not make the grade for the recently rebalanced Black Diamond Dividend portfolio. The Black Diamond is rebalanced each quarter, taking profits on some stocks whose dividend yields have fallen.
Meaning the price has gone up.
These are stocks that by some standards are fairly strong, but are missing one or two factors.
Mm-hmm.
One such stock is Duke Energy Corporation.
Right.
Once a prize plum in many portfolios, but now with a few kinks in its armor. Its sector in utilities.
Is utilities, yeah. Mm-hmm.
And specifically, Duke is the electric power business, and they're big in the Southeast. Where
They
I used to
are,
live.
aren't they? Yeah.
It's trading around $84 a share with a market cap of $57.9 billion and a dividend yield of 4.09%. Beta factor is 0.26.
Yeah, so it trades at less volatility than the S&P.
So far, those are pretty good numbers. A big company with strong market share, a higher dividend yield, and trading with less volatility than the S&P. However, it's trading very close to its 52-week high with a P/E ratio of 22.5.
Yeah.
The sector sports a 21.3 P/E, so Duke may be near a peak.
Yeah, it's over the top of the sector.
The dividend may be higher due to the payout ratio being high.
Yeah, so not a healthy reason for that dividend being 4.09 in our view.
The 52-week price range is $72 to $88 a share, trading well above its 200-day average.
Right now at 84, right?
It has strong dividend growth history. The decision was made to reject the stock this time and keep the stock on the watch list.
Right.
Duke Energy Corporation is an energy company with operations in three business segments: regulated utilities, international energy, and commercial power. The regulated utility segment conducts operations primarily through Duke Energy Carolinas, Duke Energy Progress, Duke Energy Florida, Duke Energy Indiana, and Duke Energy Ohio.
Big outfit. The international energy segment principally operates and manages power generation facilities and engages in sales and marketing of electric power, natural gas, and natural gas liquids outside the United States. The commercial power segment builds, develops, and operates wind and solar, renewable generation, and energy transmission projects throughout the continental United States. Duke Energy also operates in the United States and Latin America, primarily through its direct and indirect subsidiaries. Duke has an above-average dividend safety score, suggesting that the company's dividend is very safe. The company's earnings payout ratio over the last 12 months is 71%, however. We cut it off at 70. That's the main reason for rejection. This is getting to be on the higher side, but less of a concern for utility companies because their cash flows are generally much more stable.
Here's the problem. Company hasn't consistently generated free cash flow, recording positive free cash flow in only 5 of its last 12 fiscal years.
Yeah, right.
Now, this can be a sign of a lower quality business model and lead to greater dividend risk in the future. But companies in this industry typically have solid access to financing, mitigating some of the risk. As a utility business, Duke's returns on invested capital are limited to moderate levels because the business is capital intensive and often subject to regulatory oversight.
Mm-hmm.
Company's return on invested capital was 3% in its most recent fiscal year. limiting its ability to compound earnings as efficiently as other types of businesses. During the financial crisis, Duke's sales declined by 4%, but the company's financial strength was great enough to allow it to increase its dividend, which has grown for more than 10 consecutive years.
Yeah, they showed their commitment to the dividend.
Many companies performed worse during the financial crisis, which means that Duke might not be as sensitive to the economy's overall health as many other dividend stocks. Duke stock returned minus 22% in 2008, outperforming the S&P 500 by 15%.
Mm-hmm.
Finally, it's worth mentioning that the stock's price has been significantly less volatile than the market in recent years. And this could be a sign that the company's cash flows are very predictable and less sensitive to economic news impacting the market.
Yeah, Duke was rejected primarily for being overpriced right now and having that 71% payout ratio, paying too much of its free cash flow as dividend. It is on the future watch list for us, though. The next stock which came very close to making our A list and is certainly on the watch list for the Black Diamond, is Cracker Barrel Old Country Store, Inc., symbol CBRL.
Cracker Barrel is a consumer discretionary stock in the food and restaurant business. Its price is around $166 per share. Yeah. Market cap $3.9 billion. The dividend yield is 2.89%, just below 3%, and the beta 0.52, so it's less volatile than the S&P 500.
Right.
Cracker Barrel Old Country Store, Inc. is principally engaged in the operation and development of the Cracker Barrel Old Country Store concept.
Yeah, it's kind of fun.
Their 600-plus company-owned stores are intended to appeal to both traveler and the local customer.
Mm-hmm.
The format of their stores consists of a trademarked rustic old country store design, offering a full-service restaurant menu featuring home-style country food.
Where the waitresses call you hon.
That's right. And a wide variety of decorative and functional items featuring rocking chairs, holiday and seasonal gifts, toys, apparel, cookware, foods, and goo-goo candy. Menu items.
Yeah, you buy some of that. Huh?
Menu items are moderately priced. The restaurant does not serve alcoholic beverages.
Yeah, CBRL has a dividend safety score in the 90s, suggesting that the company's dividend is extremely safe. The company's earnings payout ratio over the last 12 months is 53%. This is a reasonably safe payout. Remember that Duke had 71. Cracker Barrel is only paying 53% of its profits out in dividends. So that's a good thing. Importantly, Cracker Barrel has been a consistent free cash flow generator and recorded positive free cash flow in 12 of its last 12 fiscal years. That's great. Free cash flow is the sign of a healthy business and is needed to fund sustainable dividends. CBRL has generated returns on invested capital between 5% and 10% most years. This level of return suggests that CBRL's moat is about average for the industry. During the financial crisis, CBRL's sales declined by 1%, and the company's financial strength was great enough to allow it to increase its dividend, which has grown for more than 10 consecutive years. Many companies performed worse during the financial crisis, which means that Cracker Barrel might not be as sensitive to the economy's overall health as many other dividend stocks. Cracker Barrel stock returned minus 34% in 2008, outperforming the S&P 500 by 3%. Finally, it's worth mentioning that the stock's price has been significantly less volatile than the market in recent years. Status, it's on the watch list for us. Remember, it's just a little too high priced right now, among a few other things. Remember, we make no recommendations to buy or sell any stock on the air here on Mastering Money. Past performance not predictive of future results.
Retire secure by getting logical with your money. Make the smart call to IQ Wealth Management and retirement strategist Steve Jur-itch, one of Arizona's leading 401k rollover advisors and the originator of the Black Diamond Dividend strategy. Steve can help turn your risky pile of mutual funds with unreliable dividends into a quality retirement portfolio with built-in security and consistently growing dividends. Steve works with a team of independent tax, accounting, and legal professionals, including CPA Nick Stefaniak, attorney Richard Dwarnick, and master tax advisor Doris Milton to help you build a financial and estate plan second to none. It all starts with a free second opinion of your current financial plan and upcoming rollover or your current annuity. Find out why more listeners are turning to Steve. Call right now, 480-902-3333. Visit IQWealth.com and BlackDiamondDividend.com.
It's not what you make, it's what you keep that counts. and what keeps coming your way. Cut your fees, lower your taxes, increase your income. More for you and more for the people you care about most. That's the IQ Wealth Strategy. To schedule a complimentary review with Steve, call 888-310-1776 from anywhere. Stay with Money Radio. The journey continues.
To learn more about the Black Diamond Dividend strategy or to hear the rest of the show, click the link right now and see the IQ Wealth Management website. Learn more right now about why dividends have one of the best track records in market history. Click the link now to retire and stay retired.